Today we're going to go over the personality of waves. Each of the waves 1 through 5 and A through E all have different characteristics that we can watch in the market to help us understand if we have the correct count. We'll go over what these waves are supposed to look like, what volume is supposed to be like during them, and how they really play together to paint a picture. So before we actually talk about the personality of waves, there are two things I need to get out ahead of time. Number one is talking about volume. Now, Elliott used volume as a tool for verifying wave counts and in projecting extensions. Volume is key for understanding where we are in a count and validating that it's correct. When we're in a bull market, volume has a natural tendency to expand and contract with the speed of price change. To understand this, let's take a look at Twitter again. We went over a full Elliott Wave count of Twitter just 2 parts ago, and if you remember, we labeled this initial structure here as our impulse. Now let's take a look at volume during this impulse. In our very first wave here, you can see that the volume is pretty low to start out, and we hit a peak of volume right near the top of our wave 1. As we drop into wave 2, volume decreases again, and once again peaks near the bottom of wave 2. Moving into wave 3, we usually see that wave 3 has the largest volume. So now if we just look at volume during wave 3 here, you can see it's significantly higher all the way through than it was in wave 1 back here. And furthermore, even though we're looking at a 1, 2, 3, 4, 5 on a larger scale here, we know that our 3 wave has the same impulse inside of it. And so if we just zoom into that and look even inside of that one, you can see that our huge volume spike at the bottom right here comes at exactly the same point that we have our 3 labeled here, with the same exact volume trends, with this being the volume of the 1, the 2 being lower volume in here, volume of the 3 is our spike as we just said, our 4 has decreasing volume, and our 5 with less volume than our third. And then looking back at our overall structure, here's our 4 wave, you can see that our volume starts to decrease as we come down to the end of the 4 wave, with the bottom of the 4 wave being pretty much the lowest volume we've had since the top of our 3rd wave. And then as we start to come up for our 5th wave, those subdivisions play in again, but if we just look near the end where the highest volume peaks are, we have right here. So we might predict that this is the 3rd wave of our 5th wave. And finally, volume starts to peak right around this area after this again, which starts to line up with exactly the top of our 5th wave. The second concept I want to dive into briefly is talking about the right look of a wave. Now what I mean by this is basically that the overall appearance of a wave is super important and helps you understand if your count is correct. So again, let's just consider that 5 wave impulse we have drawn here, and let's try to think of an alternative way we could have drawn this. We could have said that this 1, 2, 3 is just an ABC instead, making up the A wave of a larger ABC, which would look something like this. With our A up here, our previous 4th wave would be our B, and then the top here would be our C wave. So just looking at the yellow count, we could have just said this was an A, B, C instead of the impulse we have it subdivided as. So how do we know which one's correct? This is something you'll learn with more practice, but in this exact example, I went with an impulse instead of an ABC because this B wave just isn't correct. The first thing I noticed here is that look how long the A would be. It would make up all of this 1, 2, 3 compared to how short the B would be. The second thing here is that if our A wave was this and we had an ABC making it up, that means we'd have to be making a flat. And in a flat wave, the B has to retrace almost all of the A wave, which clearly it doesn't. It's pretty narrow. If we just pull a Fibonacci retracement from the bottom of our A wave back here somewhere to the top here, it only retraces about 50%, which for a flat would not be allowed. So in this example, those are the 2 main reasons I have this labeled as an impulse rather than a corrective structure here. So let's delete that ABC so there's no confusion. Okay, so now that we've talked about volume and the right look, let's actually dive into the wave personalities. One really important thing to note is that all these personalities of waves are just guidelines. None of them are rules. In other words, we know that a 3rd wave and an impulse has to be made up of a 5-wave structure. This is a rule in Elliott Wave and there's no way around it. We also expect that a 2 wave is going to retrace 50 to 61.8% 50% of a one wave. However, this is just a guideline. It can definitely be shorter, it's just not as probable. These wave personalities are all guidelines. They're something that we hope to be true and expect to be true a majority of the time, but we don't necessarily have to satisfy all of them. Okay, so let's start with the wave personality of one waves. About 50% of one waves are the rebound waves of major corrections and are usually heavily corrected by wave 2. Let's take a look at an example of this. So back in March of 2020, Twitter had a pretty significant decline where starting from September, we had a huge spike down, an attempted retrace on a B, and then another huge spike down to the $20 range. This rebound right here is what we've labeled as our one wave and fits into that category that I was just talking about, a rebound wave of a major correction. The average person will look at this and think that the asset is dead, that this is just one more really good attempt for them to start opening short sales on it, expecting the price to put in even new lows. However, with our Elliott Wave hat on, we know that this is actually the start of the best opportunity to buy, to catch that third wave and even the fifth wave afterwards. The other 50% of one waves come after a mix of sideways movement in the market or downside failures. So you can see ever since 2016, Twitter was basically trending sideways for almost all of the back half of 2016 and the entirety of 2017. Finally, we put in this move off of it, which turned out to be our one wave. A really good signal that this was happening is by looking at that volume as we were talking about earlier. Volume stayed pretty low all throughout this sideways movement, and then you can see these volume spikes that end up coming in. These are likely the subdivided waves of the one wave we have set out. Diving into the two waves. Two waves often retrace a majority of wave one, which actually end up setting up as bear traps. Investors believe that that one wave that they just short sold on are looking really good, that we're going to keep pushing down and put in new lows, and that the bear market is still here to stay. However, when we look at this, one of the key ways we could know that it's a two wave, aside from measuring the retracement depth, is to look at that volume as we were talking about earlier. If you look closely at the volume during the bottom of our two wave here, you can actually see that it is the very lowest point in volume, which is a huge sign that we're putting in a two wave, low volume and low volatility. So next up are the personalities of three waves. Three waves are absolutely the wave you want to catch. It's the wave we strive to trade as Elliottians. Third waves are almost always strong and broad and make the trend super obvious. Anyone who short sold at the top of the one wave and expected the two wave to be the continuation is pretty sure they're wrong at this point once the third wave is starting to come in. Confidence starts to return, people think the bullish market is back, and favorable fundamentals start to paint a picture and show up. And as we were talking about earlier, third waves almost always have the greatest volume and price movement of all waves, and they are often the extended wave. And lastly, third waves are also the most volatile point of strength. If you are watching for a breakout of resistance, it's likely going to happen in a third wave. Same thing with any sort of continuation gaps that are filled in the stock market or volume expansions. Next up, the characteristics and personalities of four waves. Four waves are actually typically predictable in depth and form because, as we were speaking about in part 8 of this series with the rule of alternation, four waves should be the opposite of two waves. In other words, if our two wave did not retrace very much, our four wave should. And if our two wave is sharp, our four wave is likely to be sideways. We also know that more often than not, the two wave is the sharp wave and the four wave is the sideways wave. Of course, in this example of Twitter, we didn't have that. We had the exact opposite. As we were just looking at, our two wave ended up retracing about 50% of the wave one, and our four wave is much deeper. Pulling a retracement, we can see that it actually comes down somewhere around the 70% retracement range. And again, as we went over when we were talking about volume briefly, the volume during our two wave here was extremely low, and the volume during our fourth wave here is much higher. So those are alternating as well. And finally, the last wave of an impulse, five waves. Five waves are typically less dynamic than third waves and don't put in as much price change. They also usually display a slower max speed of price change than the previous third, or in other words, their slope is much smaller. And lastly, fifth waves typically have less volume than third waves, as you were seeing before. Now, of course, what's an Elliott Wave video without an exception? So there is one exception to that rule. If you start to see volume in a fifth wave exceeding the volume of the third wave, it's a really good signal that you're actually about to have an extended fifth wave. So let's take a look at an example of that. Here's our third wave of the most recent move that we put in, and you can see volume is pretty decent through here, but not too high. However, once we start into our fifth wave, you can see that volume actually spikes up right in this area to put in our highest volume since our correction, about 2.5 months earlier back here. This was a really good sign that the fifth wave was going to be extended and be our largest wave, and indeed it did end up being larger than the third and the first. So we had a fifth wave extension, and the volume was a great sign of it. So now let's go over the personalities of our corrective waves, our A, B, C, D, and E. First up, the A waves. Now, just like how the one wave has investors believing that they're just having the next best opportunity to short sell, when in reality we're about to go upwards, the A waves are typically the same thing. The investment world is generally convinced that this reaction is just a pullback before new highs. In reality, the A wave is actually setting the tone for our B wave to follow. When our A wave is a 5-wave move and is sharp downwards, it indicates that our B wave is going to be much less deep. However, when we have a slow, drawn out A wave, we know that our B wave tends to retrace it almost entirely with a flat or a triangle. Moving into B wave, B waves are basically bull traps. They're speculator's paradise. Since in the A wave, people thought they were buying an extremely good retracement point, the B wave is starting to give them confidence that they're correct, and especially when the B wave is deep. However, by studying Elliott Wave, we know that these B waves are just about to be retraced fully right afterwards. That the C wave almost always fully covers the price movement that the B put in. As you can see in this ABC, in this one up here with our C fully retracing this B, and this one right here, etc. And similarly, while we're talking about these B waves and their characteristics, X waves behave the same way, and that they're just bull traps. Look at our X wave on the larger scale here. We retraced almost all the way back up, likely having bulls convinced that we're just going to go put in new highs. However, once we get close up there, we have a huge spike downwards. A terrible bull trap. Diving into C waves are usually devastating moves in the market. Because our B wave was a huge bull trap and people think that the market's just about to go upwards, nobody is prepared for these C waves to completely crush every asset, and pretty much everything gets destroyed here besides cash, as everyone is in complete fear in the middle of a C wave. C waves basically have the same characteristics of 3 waves, except that they're retracing the market instead of helping it push back upwards. The final 2 waves we need to talk about are D and E waves in a triangle. Now, Twitter doesn't have a triangle in it, so I've just drawn these out on paper to show you an example. The triangle I've drawn out here is in the middle of a bear market. So this first blue line might be an A wave with a B wave triangle and then a C wave downwards. So if we just talk about the D wave basically has the same characteristics as a B wave does, in that we're pushing back downwards or upwards in a bull market, and investors believe that our trend is just going to continue right from there. However, just shortly after, we have a wave that comes in and rejects that, putting the market back into a state of fear. And lastly, E waves. E waves and triangles appear to most market observers to be the kickoff of new trends. So where we're starting our trend downwards here, and people were convinced by the D wave, but it got rejected, now most investors are thinking that we're just going to go up, and our bear market is over, and this is the start of it. This is especially true because trend lines are one of the most easy and common things to draw on charts. And if we just draw a trend line from our A to our C, or as most investors would look at it, the 2 peaks that we had, once the E breaks above this, people typically think of this as a bullish sign, that now our bull market is starting and we're just going to go upwards afterwards. However, as Elliotticians, we know that E waves often stage a false breakdown, or a throwover of a triangle boundary line. So while most investors are thinking that the bull trend has started, in reality, this is actually just the end of our triangle before another huge move downwards. In essence, just another huge bull trap. So those are the personalities of all the waves. As I spoke about earlier, it's not crucial that all of these are always true. However, you do want to satisfy as many as possible to get the highest percentage probability on your count being correct. Nothing is ever certain in this market, so we just need to use what we have and satisfy as many guidelines as possible to try to win and be correct more often than not. If you liked this video, please click the like button and consider subscribing for future content. This really does support me and help me a ton, and I would really appreciate it. And of course, if you want to see part 10 of this Elliott Wave series, let me know in the comments below.